My name is Lauren Stevens, and I would like to introduce you to the Spring 2016 Birken Road Report on the continuing coverage of EastGroup Properties Incorporated. This report was compiled with my fellow analysts, Monica Gomez-Acabo, Inez Lucaya, and Alexander Pollard. Our company is traded on the New York Stock Exchange under the ticker EGP. We have given the company a rating of market perform with a 12-month future target price of $65. First, our presentation will focus on the history of EastGroup, followed by EastGroup's property locations. We will then move on to the company's strategy that allows EastGroup to continue its growth and discuss their new important developments. Next, we will focus on the risk analysis and the investment thesis, which discuss many of the factors that affect EastGroup. Finally, we will move on to the analysis of the company, which uses various techniques, the valuation of the firm, and our team's site visit. EastGroup Properties Incorporated is a real estate investment trust based in Jackson, Mississippi. Most of the properties owned by EastGroup are located in the southern region of the United States. EastGroup Properties was incorporated under its original name, Third ICM Realty, in 1969. That company focused its operations in the eastern region of the U.S. After rapid growth, the company made its initial public offering in 1970. That same year, Third ICM Realty simplified its name to ICM Realty. In 1983, the company changed its name a second time to EastGroup Properties Incorporated. A new management team began overseeing operations that year as well. The company then began to experience increased growth, mostly concentrated in the southern United States. Success in the South led the company to establish its headquarters in Jackson, Mississippi. Under the new and current management, EastGroup focused on industrial properties. Specifically, the company has been focusing on the acquisition and development of distribution centers located near prominent transportation channels. As of December 31st, 2015, EastGroup has over 34 million square feet of properties in several states, as shown in the picture, with special emphasis on the states of Florida, Texas, Arizona, California, and North Carolina. EastGroup strives to maximize shareholder value by leasing quality business distribution facilities located in thriving metropolitan areas with major transportation hubs and supply-constrained submarkets, generally ranging from 5,000 to 50,000 square feet. The company chooses to operate in metropolitan areas because it believes that these areas have an economic vibrancy and growth that intertwines the city's success with the success of business owners using the company's properties. EastGroup also utilizes three primary areas of growth: internal finance, property development, and capital recycling and acquisition. Internal finance is the first step to growing and fully utilizing current assets. EastGroup focuses on making sure it increases its same property results, space renewal, funds per share increases, and occupancy. The company also selects new developments in current and new areas. Development allows EastGroup to build properties that fit its specific needs. Finally, the company believes that selling older assets in order to reinvest in new capital is integral to increasing returns and growth. EastGroup sells its older properties that have a limited upward potential due to factors like age of the facility, environment, or the market of the location. In our risk analysis, the operating risks are linked to the economy and other driving forces that could impact the daily operation of the company. EastGroup also faces regulatory risk that many other real estate businesses face. This type of risk depends on the local, state, and federal regulations. Finally, notable financial risks facing EastGroup include liquidity risk, interest rate risk, and credit risk. These financial risks all represent potential threats to the company due to the nature of its investing and financing. Within the financial risk, there are three main categories: liquidity risk, interest rate risk, and credit risk. Credit debit financing is an important part of EastGroup's operations. The company needs to borrow large amounts of money to purchase and develop properties. EastGroup maintains an equity-to-debt ratio of 35% to 65%, and we project this to maintain constant. The company mainly uses unsecured loans and mortgages to finance the company's activities, along with equity issuances to maintain their debt-to-equity ratio. Our investment thesis contains 4 prominent factors that affected our 12-month target price for EastGroup stock. These factors are gross domestic product growth, occupancy rates, EastGroup's properties in Houston, and interest rate conditions. EastGroup's growth is strongly correlated with GDP. Specifically, EastGroup's growth has a 95% correlation with the growth of the economy. This shows that GDP is a useful tool for predicting EastGroup's future revenue. EastGroup's occupancy rate remains consistent with last year's performance. Since its occupancy rate largely affects the revenue of the company, the revenue from recent years gives us a fairly reliable estimate of the company's future revenue. Overexposure in Houston promotes action after oil prices fall. Due to recent developments in the oil and gas industry, EastGroup's Houston properties have resulted in one tenant bankruptcy and led to concern over potential further bankruptcies. However, the occupancy rate for Houston properties as of February 19, 2016 is 97%. We took this into our consideration for our future valuation. The Fed's plan to slowly raise interest rates has implications for EastGroup. Historically, rate increases trigger mass sell-offs of REITs, thus negatively impacting the stock value. However, increasing interest rates also signify a strengthening economy, which strengthens the sales and production of many manufacturers. Consequently, this increase in sales and production also results in increased demand for EastGroup services as the demand for industrial warehouses rises. The real estate industry recovered well from the 2008 economic crisis that heavily impacted the sector. In the years following the crisis, the real estate sector experienced great development and expansion. In 2015, the company did not purchase any properties throughout the first 9 months of the year. More recently, EastGroup felt a slight negative impact from a drop in oil prices, which affected the southern states where EastGroup primarily operates. Since the dramatic drop in oil prices, there has only been one Houston tenant bankruptcy. This will cause the vacancy rate to increase modestly, which will lead to a slight decrease in local revenue. EastGroup expects to bring new assets to the market in 2016. The industry outlook continues to stay strong for the next year, and vacancy rates are expected to stay at only about 5%. Not much additional supply is expected due to the constrained nature of the markets where EastGroup currently holds property. Compared to other industries, competitive rivalry is strong in the real estate sector, as customers are not loyal towards this market segment. Customers' preferences are based solely on the property's location, prices, and customer service. EastGroup competes with numerous other industrial REITs. Its largest competitors include DCT Industrial Trust Incorporated, Terreno Realty Corporation, and First Industrial Realty. On this table, we can see the financial comparison between EastGroup and its main competitors. Like EastGroup, these REITs also focus on properties in the southern United States. The company also faces competition on a larger scale from more global and national REITs such as Prologis Incorporated, which operates internationally but has a strong presence in the United States. We examined EastGroup using several different analyses. The first analysis we used was the Ben Graham analysis. Famous for his value investing, Ben Graham used several hurdles to determine if a stock was worth investing in. Of a selected 7 applicable hurdles, EastGroup passed 4. One hurdle passed was having an earnings growth of 7% or higher over the past 5 years. Another was having consistent earnings, meaning 1 or fewer drops in earnings per share over the past 5 years. EastGroup also passes the hurdle of having an earnings to price yield of almost double that of a 10-year U.S. Treasury note. Finally, the fifth hurdle EastGroup passed was having a dividend yield more than half the yield of a U.S. Treasury note. Given these results, Ben Graham considers EastGroup's potential as a possible value stock may be worth investing in. We also examined EastGroup using the Peter Lynch analysis. Peter Lynch used a simple charting tool to help determine stocks worth investing in. He would chart a theoretical price using a 15x earnings multiple. If the stock traded notably below this line, he would consider it undervalued and a worthy investment. If the stock traded above the 15x earnings line, Lynch would consider the stock to be overvalued or have no additional value. EastGroup trades at approximately 16.5x its earnings, placing it slightly above the 15x earnings line. Therefore, EastGroup would not be considered worthy of investment based on the Peter Lynch analysis. For our own valuation, we used a price to funds from operations multiple to forecast a 12-month target price of $65. This is a typical valuation technique for REITs. By adding back non-cash charges, this method provides an accurate idea of actual cash flows generated and available to shareholders. Looking at the 5 years of historical data, we found the company to trade in a very narrow range of an approximately 16x funds from operations. Predicting a 2016 funds from operations of $4, we took the average FFO multiple of 16.2 from the past 5 years and multiplied it by the expected future $4 of FFO. This method resulted in our expected 12-month stock price of $65. Our group took an exciting visit to EastGroup's headquarters in Jackson, Mississippi to meet key executives and learn more about the company. Executive Vice President and Chief Financial Officer Keith McKee and Vice President and Associate Controller Stacy Tyler took the time to sit with us and discuss EastGroup's strategy and outlook. They provided valuable insight into how the company operates by acquiring and developing easy-to-convert warehouses close to major transportation hubs in the Sun Belt region. They believe that this region of the southern United States is the best place for EastGroup to operate because of its growing population and up-and-coming nature that promises a future increase in economic activity and demand for EastGroup's services. On an important note, we discussed the impact of oil prices on Houston properties and what EastGroup's expectations and strategy are going forward. It was explained to us that EastGroup is confident in the continued high occupancy rate in the area based on the expectations of regional officers despite pressure on oil companies. Additionally, EastGroup plans to reduce its exposure in the area since Houston currently accounts for a significantly large portion of the company's operations. We were reassured that the company has complete confidence in the future and expects continued demand and expansion to further drive growth and continue to elevate EastGroup. Disclaimer: the Birken Road reports are produced solely as a part of an educational program at Tulane University A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.